Welcome to this deep dive into a seismic shift in North American trade. On March 4, 2025, Canada dropped a bombshell. 25% tariffs on $155 billion worth of U.S. goods, a bold counterstrike to President Donald Trump's tariffs on Canadian imports. This tit-for-tat has sparked fears of an all-out trade war between two of the world's closest economic partners. Over the next several minutes, we'll unpack the history of this relationship, the specifics of Trump's tariffs, Canada's retaliation, the economic fallout, and where this might lead. Are we witnessing a strategic standoff or the start of a prolonged conflict? The US and Canada exchange over $700 billion in goods yearly, sharing the world's longest undefended border. But Trump's recent moves, citing drug trafficking and immigration, have ignited tensions, and Canada's not backing down. This isn't their first trade spat, but the stakes feel higher now. Economists predict price hikes and job losses while leaders trade barbs. As we dig in, ask yourself, are these tariffs about security, or is there more at play? We'll sift through the facts, crunch the numbers, and tap expert insights to make sense of it all. This is a story of economics, politics, and power, one that could reshape life on both sides of the border. So, settle in, and let's explore this critical moment together. To understand today's clash, we need to rewind through centuries of economic entanglement between these North American neighbors. US-Canada trade began long before either nation formally existed, rooted in their shared colonial past under British imperial control. Early exchanges were remarkably uncomplicated. Timber, fish, and furs flowed across what was then a fluid, barely defined frontier between territories that shared more similarities than differences. The War of 1812 fundamentally altered this landscape, drawing a firm border and sparking a rivalry that would linger for generations. This conflict, which many Canadians view as their true war of independence, established not just geographical boundaries but identity ones. Canadians increasingly began to define themselves in opposition to their southern neighbors, a perception that would influence trade policies for decades to come. By the mid-19th century, both nations were experiencing rapid industrialization, but trade tensions began to brew. The United States implemented protectionist tariffs to shield its emerging factories, such as the infamous 1828 Tariff of Abominations, which raised rates to as high as 62% on some manufactured goods. Canada, then still a British colony, responded with its own duties, establishing a pattern of action and reaction that would characterize the trade relationship for generations. Fast forward to the 20th century. The Great Depression devastated bilateral trade, reducing exchanges by more than 60% between 1929 and 1933. The beggar thy neighbor policies implemented by both countries only deepened the crisis. World War II completely reoriented these dynamics, redirecting production toward war efforts and forging a strategic alliance that would lay the groundwork for post-war cooperation. After 1945, both Canada and the United States joined the General Agreement on Tariffs and Trade, GATT, committing to ease trade barriers globally. This multilateral framework provided the first serious step toward trade liberalization between the two nations, though progress was gradual and often interrupted by specific sectoral disputes. The big leap came in 1988 with the Canada-US Free Trade Agreement, FTA, which eliminated most tariffs, boosting cross-border business dramatically. This agreement, controversial at the time, especially in Canada where many feared the loss of economic sovereignty, fundamentally transformed the bilateral relationship. Then, in 1994, the North American Free Trade Agreement, NAFTA, tied in Mexico, forming a $1 trillion trade bloc that integrated North American economies like never before. This trilateral agreement expanded the scope of the FTA, incorporating provisions on labor rights, environmental protection, and dispute resolution. By 2019, US-Canada trade reached an impressive $718 billion. Energy, automobiles, and machinery heading south, consumer goods and technology flowing north. This massive exchange made Canada the United States' largest trading partner, surpassing even China in total trade volume. Disputes persisted though, think Canada's dairy quotas or US lumber duties. These sectoral frictions, though limited in scope, kept trade tensions alive even in times of increasing integration. In 2020, the United States-Mexico-Canada Agreement, or USMCA, replaced NAFTA, tweaking rules on labor and digital trade, but keeping the free trade core. Trump hailed it as a triumph of his administration, touting it as a more favorable deal for American workers. Yet here we are, facing tariffs again. Past clashes, like the 2018 steel dispute, ended in deals after calculated retaliation. Canada's $16.6 billion in counter-tariffs then nudged the U.S. to lift duties by 2019, demonstrating the effectiveness of a firm but proportional response. Today's fight dwarfs that episode. $155 billion in play signals an entirely new scale of conflict. Historically, negotiation has prevailed, but Trump's unyielding rhetoric and Canada's resolve hint at a tougher road to reconciliation. Is this a repeat of old patterns or a break from them? The past suggests talks will eventually yield compromise, but the present feels less predictable, with leaders on both sides seemingly willing to endure economic pain to defend their positions. Now, let's zero in on Trump's move. On February 1, 2025, he signed executive orders imposing a 25% tariff on most Canadian goods, effective March 4th, with a reduced 10% rate on energy, oil, natural gas, and hydroelectric power. Why such a drastic measure? Trump has pointed to drug trafficking, especially fentanyl, and illegal immigration, claiming Canada's lax border control threatens U.S. security. To implement these tariffs, he invoked emergency powers, tying them directly to what he described as a national security crisis. Trump's no stranger to this tactic. His 2018 steel and aluminum tariffs, also pegged to national security under Section 232, sparked a brief trade skirmish. This time, however, the scale is much larger, affecting virtually all bilateral trade rather than specific sectors. The White House argues that Canada's border is a pipeline for drug trafficking, though 2024 data shows just 2% of fentanyl seizures occur there versus 90% from Mexico. Immigration statistics tell a similar story: 23,000 illegal crossings from Canada last year, a tiny figure next to the 1.5 million from the southern border. Critics call the security justification a stretch, arguing tariffs won't seal borders but will certainly raise costs for consumers and businesses in both countries. Exemptions are slim. USMCA-compliant automobiles received a 30-day delay after industry pushback, but little else has been excluded from these tariffs' reach. Trump's framing this as a 2024 campaign win: secure borders, boost American jobs. Yet the U.S. trade deficit, $1 trillion in 2023, won't shrink much. Canada represents just 15% of this imbalance. Businesses are bracing for chaos. Supply chains like Detroit's auto plants critically depend on Canadian parts. Is this a bargaining chip or a policy shift? Trump has hinted at openness to talks but set no clear conditions for resolving the dispute, leaving markets jittery and analysts divided on his true intentions. Canada struck back fast and decisively. On March 4, 2025, then Prime Minister Justin Trudeau unveiled 25% tariffs on $155 billion in U.S. goods. Phase 1, $30 billion, effective immediately: steel, aluminum, appliances, even orange juice from Florida. The rest, $125 billion, looms as a second phase if Trump holds firm on his tariffs. Finance Minister Dominic LeBlanc made it clear, this is about protecting Canada's economy and exerting maximum pressure to force the U.S. to reconsider. That initial $30 billion package breaks down strategically: $12.6 billion in steel, $3 billion in aluminum, and $14.4 billion in consumer goods like computers, furniture, and sports equipment. Trudeau's message was unambiguous. These countermeasures will remain in place until U.S. tariffs are lifted. The selection of targeted goods wasn't random. Many come from politically sensitive swing states that could influence U.S. policy through domestic pressure. Ontario Premier Doug Ford flexed additional muscle, threatening a 25% surcharge on electricity exports, powering over 1 million U.S. homes in states like New York and Michigan, before temporarily pausing the measure to allow for diplomatic talks. This energy leverage represents a powerful card in Canada's hand, one they've indicated they're willing to play if necessary. Canada's playing hardball elsewhere too. Nova Scotia banned U.S. firms from public contracts worth millions, and Ford's provincial government scrapped a planned $100 million Starlink satellite internet deal. These actions demonstrate that this isn't just economics, it's a sovereignty flex. The US offered what it called a compromise, reduced 10% tariffs both ways. But Canada flatly rejected the proposal, demanding complete removal of all tariffs as the only acceptable outcome. The Canadian strategy appears aimed at hitting US exporters in politically sensitive regions to shift pressure onto the Trump administration. With Mark Carney stepping in as Prime Minister on March 14 after Trudeau's unexpected resignation, Canada's tactical approach might evolve, but for now, the stance remains ironclad. Many analysts note that Carney's background as former Bank of England and Bank of Canada governor brings sophisticated economic expertise to this trade battle. Is this a smart counter, or does it risk too much? The next move belongs either to Canada's new leadership or to Trump's administration, with billions of dollars and thousands of jobs hanging in the balance. Here's where the consequences get real for businesses and citizens on both sides of the border. For Canada, US tariffs threaten a potential 2.6% GDP contraction, according to recent Bank of Canada projections, translating to approximately $60 billion in economic activity wiped out. Canadian exports, 75% of which go to the US, face a formidable barrier. The $413 billion shipped in 2024 could shrink dramatically as American importers seek alternatives or pass costs to consumers. Jobs, up to 1 million positions stand at risk, particularly in manufacturing hubs and auto towns like Windsor, Ontario, where cross-border supply chains have been the lifeblood of local economies for generations. Consumers will inevitably pay more for US technology, vehicles, and food. Industry analysts estimate $2,000 extra per automobile as parts costs soar throughout the supply chain. Canadian firms using American inputs, from manufacturers to agricultural processors, might be forced to reduce output, raise prices, or both, potentially losing global competitiveness in the process. Canada's government has begun exploring expanded trade with Asia and Europe as alternatives, but establishing new trade relationships and logistics channels takes years, not months. In the meantime, the economic pain would be substantial and widespread. For the United States, Canada's $155 billion retaliation strikes at $63 billion in exports, making this the second largest trade conflict after the ongoing China dispute. Individual states face varying levels of exposure: Michigan with its automotive industry, New York with its electricity sector, and Washington with its aerospace industry feel the impact most acutely due to their deep integration with Canadian markets. The Nonpartisan Tax Foundation projects a 0.2% GDP reduction, approximately $40 billion, and potentially 223,000 jobs lost across manufacturing, agriculture, and service sectors. American households could face an additional $1,072 yearly as prices climb for everyday goods and essential services. Gasoline prices could rise by 50 cents per gallon in Midwest states, where Canada supplies 70% of crude oil imports. Lumber tariffs may increase home construction costs by 5 to 10%, further straining a housing market already impacted since similar tariffs in 2018 pushed up building expenses. Both governments could implement measures to cushion these impacts, Canada through targeted industry support, the US with selective exemptions, but a prolonged fight would inflict deeper, potentially structural damage to integrated North American supply chains built over decades. Security gains from these tariffs remain difficult to quantify in concrete terms. Economic pain, however, is very measurable and already beginning. What's the ultimate trade-off being made here? Is it worth it, or a strategic misstep? The numbers don't lie, but the political calculations behind them remain contentious. Could this conflict intensify further? Absolutely. Trump has publicly mused about elevating tariffs to 50%, a move that would devastate bilateral trade, or potentially targeting Canada's financial institutions with restrictions. Canada, for its part, could expand its $155 billion tariff net to include additional categories, restrict exports of critical minerals and rare earth elements vital to U.S. manufacturing, or revive Ford's electricity export surcharge threat. The trade conflict could expand beyond conventional tariffs into other economic domains: investment restrictions, regulatory hurdles, or even currency interventions. Such escalation would significantly raise the stakes and potential damage. However, diplomatic avenues remain open. The scheduled 2026 USMCA review represents a natural opportunity to reset trade relations with a comprehensive negotiation. The World Trade Organization could also play a mediating role. Canada has indicated it's exploring a formal case, and Mexico might join as a third party, concerned about regional trade stability. Businesses suffering on both sides, automotive giants, agricultural exporters, energy producers, have begun lobbying intensively for diplomatic resolution. The economic pain creates a natural constituency for compromise that could eventually outweigh political considerations. Expert opinions diverge on the timeline. Some predict a quick deal by June as economic damage mounts. Others foresee a multi-year standoff that could permanently alter North American economic integration. History suggests eventual compromise, but the political landscape today features less predictable leadership and more polarized domestic politics than previous disputes. Globally, the European Union's recent implementation of $28 billion in counter-tariffs against similar U.S. measures could inspire a broader coalition against what many see as Trump's aggressive trade tactics. Multiple simultaneous trade conflicts could compel a reassessment of American strategy if economic costs multiply. Mark Carney, Canada's new Prime Minister, brings a sophisticated financial perspective to the conflict. Will he prioritize defiant resistance or pragmatic dialogue? His experience leading central banks during economic crises suggests a calculated approach focused on Canada's long-term economic interests. Trump has occasionally made provocative comments about Canada as a 51st state dependent on American markets, remarks dismissed in Ottawa as unhelpful rhetoric. Ultimately, resolution hinges on which side feels greater economic pressure first, creating incentives to compromise. Escalation comes easily in trade disputes. De-escalation requires political courage and economic pragmatism. What's your assessment? Are we headed for more barriers or eventually back toward a bridge of cooperation?
Check, check. Check one, check two, check, check.
Let's tie it all together. Canada's $155 billion tariff counteroffensive against Trump's $413 billion strike has placed both nations in precarious economic territory. GDP growth is threatened, employment stability is compromised, and consumers are beginning to feel the impact through higher prices for gasoline, housing, groceries, and manufactured goods. Further escalation remains a genuine possibility, but diplomatic pathways through the USMCA framework or WTO intervention could still pull both countries back from the brink. The conflict pits security concerns against economic sovereignty, with global observers watching closely for implications to their own trade relationships. Are these leaders pursuing political victories worth the economic cost, or will practical compromise eventually prevail? The economic data strongly suggests the latter would benefit citizens on both sides of the border. But political calculations don't always follow economic logic. This evolving story continues to develop daily with potential implications for North American integration that could last decades. We'll continue monitoring developments and providing analysis as this critical situation unfolds. Thank you for joining this comprehensive exploration of what may become the defining North American economic story of 2025. If these insights have sparked questions or perspectives, I encourage you to share them. The debate around trade policy affects us all, whether through the prices we pay, the jobs available in our communities, or the broader economic stability we depend upon. What's your view? Should leaders escalate to protect principles or negotiate to preserve prosperity? The choices made in Washington and Ottawa in the coming weeks may reshape the economic landscape we all inhabit for years to come.